Welcome to the July Market Thoughts video. My name is Maria Considine King, and I'm joined by Brad McMillan, Chief Investment Officer at Commonwealth Financial Network. Brad, the Dow ended June up almost 4% on positive news out of Europe, and the S&P and NASDAQ had similar positive results. Do you think this could be the start of a sustainable rally, or do you think that the markets are overreaching a little bit?
Well, first of all, never underestimate the ability of the markets to incorporate positive news. I certainly don't think this is necessarily going to end in the short term. Longer term and medium term, though, I think we've seen this movie before. With Europe, you have the European Union meeting, they announce a solution, the markets go, hooray! And everybody jumps back in the pool, but later on it turns out that, in fact, once again, the EU has addressed the symptoms, but not the underlying problem. I think in this particular case, that's exactly what has happened once again. The symptoms have been addressed, and they seem to have been addressed in a very constructive way. I don't want to minimize what's been done. It's a good thing. But at the same time, you now have a situation where the underlying issues of solvency are still there, and they will emerge again in some way. I don't know what that way is going to be, but they will be around. So I don't think you have solved the problem, and I think that will be back, and I think you may well have a first quarter May situation again where a lot of the gains that were given will be taken back.
U.S. bond yields are at or near historic lows. What should fixed income investors be paying attention to in the coming weeks?
The bond yields are currently probably the biggest outlier out there, in my opinion. And you have a situation where you have to consider, first of all, what got us here, and second of all, is it likely to continue? And there are two things that have gotten us here. The first is massive risk aversion on behalf of pretty much all investors. I believe households are one of the largest, if not the largest, buyers of U.S. Treasuries right now. So there's huge risk aversion and huge demand of Treasuries because of that. And the question is that risk aversion going to go away? And I think the answer, as in my previous answer, is probably not in the medium term, although possibly in the short term. But the answer in general would be no. Second of all that got us here is the Fed making an explicit commitment to keep interest rates low. Is that going away? Well, if you listen to the Fed, the answer is absolutely not. And you have a situation where the Fed has made an explicit commitment to continue buying long-term treasuries at the cost of short-term treasuries. They can keep doing that for another 3 months or so. So consequently, they are going to continue to do that. So interest rates are not going anywhere, but what you need to watch is the level of risk aversion and the Fed's willingness and ability to keep manipulating the interest rate curve.
Are there any market segments that you are particularly cautious about?
I think the one that I'm really looking at the most closely right now is employment. We had a very strong first quarter, and then it's weakened in the second quarter, but it's continued to grow. Now the question is that now going to roll over and go into a decline? Is it going to kind of stay where it is, or is it going to start moving up again? The indications seem to be that there's a reasonable chance it's going to start moving up again, which is a very positive sign, but that is by no means assured. That to me is the major thing that I'm watching at the moment.
What economic indicators are you hopeful about that maybe have turned the corner from their historic lows?
I think the real wild card here in terms of whether it comes off the bottom strongly or just kind of comes off gently is housing. I do think we've seen a turnaround in housing. I don't think that is as generally appreciated as it will be later on. So I think that is the real thing that we need to look at and pay attention to and say, how hard is this growing? For a couple of reasons. First of all, housing typically leads recoveries. Second of all, housing provides a lot of employment opportunities for the people that have been hit hardest by the unemployment crisis. Third of all, housing is a huge multiplier for the wealth effect. As housing values recover, people become wealthier and they spend more. Consequently, housing is the real chance for an outsized surprise as I see going forward.
Thank you, Brad.
Thank you, Maria.
And thank you. Please join us next month for the Market Thoughts video.